Hello, nice to see you all today. For the record, I'm Natasha Detweiler-Daby, Director of Affordable Rental Housing at OHCS, and hello, Vice Chair Brees Iverson and committee members. So I'm really, let's see, I'm going to aim this way. I'm really happy to be with you all here today to talk about preservation. I think that it is not something, I think that we talk a lot about it, but it's not just preserving the housing units, but it's really about protecting the billions of dollars that have gone into creating and building and expanding an affordable housing portfolio. And by doing that, preventing systemic housing loss across the state, and really ensuring that we're doing what we can to further stabilize versus destabilize communities as we do that. And so as we think about what preservation is, there's, three primary categories that we would think about preservation for traditionally. And so that is for our affordable rental housing portfolio specifically, projects that have expiring federal rent assistance. Those are whether, supported by HUD, and they have project-based rental assistance. And so when those projects expire, what happens to those tenants, but also where does that rent assistance go? And then there are the expiry of rent restrictions. And so that is where, in the absence of rent assistance, we fund affordable rental housing that is income and rent restricted. So making sure that those rents are set at affordable levels. And then there are all of the things that otherwise create a risk of loss to housing, which are either the financial operations are not working or there are physical condition challenges. So as we think about the, expiry, I think it's the most specific. There's a date that is created at the time when that project is first developed and financed. And all of the financing tools, federal tax credits and otherwise are designed with expiry in mind. So the idea of holding those projects affordable and that what our public investment is getting is that period of time that would be held in affordability. And so we know that we have, as a state, invested in robust strategies to ensure the best chances that we can identify where those expiries are coming and make sure that we're doing what we are able to make any affordable preservation of those projects viable. And from all of the amazing data that are tracked and in active dashboards online, we know that there are over nearly 3,641 units that are anticipated and due to expire in those affordability restrictions between now and June 1st of 2029. At the same time, and I think that the legislature has heard quite a bit around the challenges in operations of affordable housing. And I would say that this is not a unique situation to Oregon. Certainly, it is a national trend. And I think it's also a national trend for all who are experiencing what are increased costs of living and either stagnant or variable and challenged income streams. And so what we have are projects that have been placed in service, are being placed in service, and finding that they're operating in a different world of costs. So the bills, the costs of the, paying for basic maintenance staffing, insurance, and all of the maintenance and care and effort for projects are continuing to escalate while the rents are stagnant and candidly, a lot of challenges with on-time rent payments and all of those persistent dynamics that have been existing in the state and across the country for the past 5 years. And so at OHCS, we took the time in the past year to figure out what it is that we could find from our own portfolio of housing. We have the most significant amount of data in the state around what are the operations of our projects really doing. So with the caveat that our data is based on the annual audited financials from the year before, it's a little bit behind. And so the data that we have is from 2023, and what we found is that 39% of our affordable rental housing portfolio had debt coverage ratios of less than 1.1. And so that 1.0 means you have enough money to pay all of your bills. And so that means that 39% of our portfolio as of 2023 was hardly having enough resources to make ends meet. And that represents a 44% increase over the same rate in 2021. So that difference is showing both that is a trend of continued increase, disruption to those operational budgets, and that trend, though we don't have the data for the subsequent years, from all we are talking and engaging with lenders and owners of projects, that is a persistent trend. And it is generally, across all types of different areas. We have, some of the data here. We have the full analysis online. And while year over year, it might be that increased 5%, and we would have thought that would be 2%. When you compound that year over year, you really start to have the place of the impacts get larger and larger. So it's an exponential increase over time. And what this generally has meant is that organizations who are our stewards of our affordable housing are needing to prioritize across their needs. And so whether that is they're finding, programs that they can cut their delivery of so that they can redirect those resources, so that they can find ways and to make sure that housing can remain stable. And it starts to then deteriorate. What is the amount that you can invest in those maintenance needs and other types of, general supports that you would want to have to make sure that you're keeping your housing healthy and safe for your tenants? So we have this last legislative session, we're very thankful for $50 million in legislative investment. In addition to these, the actual funding sources here on your screen, there was other investment in statutory program language to give some a basis for understanding and navigating towards. And there was also additional refinement in our regulations that are kind of trying to give both projects and tenants certainty and clarity when there is that project hitting the place of expiration. And then there was another investment for some supports around those insurance costs that we're working in partnership to consult with Business Oregon as they invest those resources, establish the way to invest the resources. So as we are looking at these funds, generally, I guess here's the list of all of the things I should have had up as I was saying that. So as we are looking at all of the resources, we are trying to activate all of the funds to the ways that they can maximize impact. And so when we're looking at our, underneath that $50 million, general preservation, and so those are resources that we're leveraging with some other with our ORCA process to identify these projects that are waiting, were at risk of loss from expiry, are needing to move forward. We're able to leverage our 9% federal low-income housing tax credits. There was an increase to that allocation, so we're able to fund a few projects there, and are leveraging these $15 million to support both this cohort as well as the 9% tax credits that we'll have available to offer next year. The $35 million, we are in the process of opening that resource offering. Next week, we'll be sending out on Wednesday the information with full details to developers who are seeking stabilization investments. And those are really an intervention that is specifically focused on this explicit moment where that operational deficit has meant that projects' base operations are out of sync with what they are actually able to do in the market. And so we have engaged with lenders, we have engaged with owners on those projects and identified that it's a low level investment into individual projects, but with the idea of buying down some of that debt, recasting it, also leveraging updates that were adopted in this last session to the Oregon Affordable Housing Tax Credit to better allow banks to add those interest rate reductions to existing loans, to be able to stretch that as far as we can as we see the critical need. And I think knowing that these are projects that are imminent risk, so meaning they are owners and operators who are trying to forestall a foreclosure. And in the case of a foreclosure, that means a wealth of uncertainty for those tenants as that project's next steps are navigated, but also for the long term.
I think we have a question.
Quick question. So thank you for this information. So the percentage of the properties with the DCR under 0.1, 39%, does that mean, DCRs are in loan documents. I would imagine that is a technical default. So are we saying that almost 40% are potentially in default under their loan obligations?
And so they are, for the most part, there are some loans that are in default with their private lender. And so with their private lender, there's also the majority of those are organizations that have been trying to pull the resources to keep them current. And so trying to make it so that they can do that. And what that has done to the organizations is deteriorate their financial health as they're needing to redirect resources that they would have normally used for other purposes. But that 39% is really break even. So that is just the resources that, they have in 2023 had exactly what was needed to pay their bills. And so that has continued to exacerbate over time. But they are largely, as we're talking with lenders, all of the different workouts and different strategies at this point have been treading water, trying to stay current, but really are at the tipping point where something needs to change. And I guess there's also a lot of efforts by organizations in the past couple of years as these trends were really emerging to divest of their portfolio. So try to find other owners or operators that would be able to assume ownership of those projects. And at this point, the challenge really is that there aren't buyers that have resources for those. While there might have been for a brief period of time, we don't have subsidy to add into those purchases. Most of those purchases require more than just federal tax credit leverage. And so certainly providing ability to do federal tax credit leverage where we have those resources available, but we are finding that subsidy limitation continues to be a need across most of our projects.
Thank you. Quick follow-up. So with this almost 40%, I guess I'm confused if their DCR is under break-even point, how are they not underwater? Or are they underwater and they just can get through it because their DCR is not in their loan documents or they're not servicing that kind of debt?
So I think so I think that they are upside down but keeping themselves current.
Okay.
And so I think whether what their loan terms is with their private lender, I think where the lenders continue, and I think the lenders are acutely concerned, are flagging not only risk to the properties, but the organizations as a whole, as we think about the groups and organizations that are the infrastructure for housing across the state.
Thanks, that's really helpful.
Thank you.
Great.
We have one more question over here.
Oh, yeah.
You probably can't answer this today, but I would welcome hearing from those organizations who are on the verge, who are in challenge. What can we do in a positive way to help them get through this shortfall? And it could include some additional state programs, some additional state funds, because if you have an existing resource and you have someone that's residing there, you have in place rental housing, and we want to maintain it. And I would be curious about what can we do to help these folks maintain their rental housing? And maybe it's identifying some other avenues of support from the federal government. Maybe it's modifying our thinking about how landlords ought to be treated economically, and I mean in a merciful way, not a negative way. But I would welcome feedback about things that have come back saying, well, hey, we could do better. And that's sort of an open-ended question for later.
Okay, great. Thank you.
Thank you. We'll leave it open-ended and let her continue on, and we'll get potentially some ideas as she finishes.
Yeah, absolutely. And I guess I do also just want to emphasize, none of the organizations that are doing this are showing that there was neglect or intent or insufficient planning. It really is characterizing the environment, and the environment has changed, just like so many household budgets where the costs continue to escalate.
All right. Any more? You have one more? Okay, very good. Thank you. Thank you for sharing with us today. We appreciate the insight of what's coming.
Great.
I'm just looking for some.
And we will move on to our next one. Are you, Erica? Come on up and join us. Thank you. When you are ready, go right ahead.
Thank you. Good afternoon, Vice Chair Bruce Iverson and members of the committee. My name is Erica Mills. I'm the CEO of NeighborWorks Umpqua. We are a rural community development corporation based in Roseburg. We serve Douglas, Coos, Curry counties, and all the surrounding counties. We manage affordable rental housing, support homeownership, and streamline economic resilience in rural Oregon communities. We are very much a poster child for what Natasha just illustrated. So you're already very familiar with the need for affordable housing preservation. What I want to share today is why this issue is so urgent and why it's so relevant in rural Oregon. Let me start with Coddington Place in Coos Bay. That's in Representative Wright's district. This is a 10-unit property that we co-developed with the SAFE Project, a domestic violence serving provider. Like many rural properties, it's too small to achieve an economy of scale, and a few late rent payments, a staff turnover, an unexpected maintenance issue can push it into financial crisis. This summer, a small loan on this project for only $135,000 matured. The property had accumulated no reserves. Refinancing options were nil. We couldn't support new debt at current interest rates, and we couldn't sell the property because of long-term poor performance and inability to meet debt service coverage ratios. When we turned to OHCS for help, there were no preservation tools available, only a warning that default could trigger a $1 million grant recapture. $135,000 of balloon payment that we couldn't meet would result in a $1 million grant recapture for not just NeighborWorks Umpqua, but also for the SAFE Project, our partner in this project. That's an impossible position. Small nonprofits being asked to absorb risks we can't manage for problems that we can see coming, but we have no tools to solve. Coddington had a happy ending, though. NeighborWorks America came to the rescue with a grant to cover that balloon payment, and Umpqua Bank was extremely collaborative in extending their loan terms beyond their bank policies while we waited for those funds to come in. But that was the exception. Across our portfolio and across rural Oregon, hundreds of properties face similar cliffs. Some, like Hillside Terrace and Coquille, face wildfire and infrastructure risks. Others, like the Grand Apartments in Roseburg, have failing building systems. These aren't isolated cases. They're systemic risks that destabilize both the families and the nonprofits who serve them. When rural nonprofits go under, it isn't just one landlord lost. It means the collapse of local housing expertise, community trust, and the only institution willing to build and preserve affordable housing where the private market will or cannot. You already have acknowledged the need, but the funding approved falls far short. Lottery bonds alone can't close the gap. The solution is within reach. Using 11Q general obligation bonds already used for LIFT can also support preservation. The legislature should direct OHCS to establish a preservation program that uses both lottery and 11Q bonds. Even a modest allocation will stabilize properties now and help build capacity for the long term. Waiting until 2027 will put thousands more Oregonians at risk of losing their homes. Rural preservation is not optional. for families in Coos Bay, Coquille, Roseburg, and small towns across Oregon. It's the difference between stability and homelessness. Please help give us the tools to prevent these losses. Thank you.
Thank you, Erica. Do we have any questions for Erica from, no? No questions?
Madam Chair.
Yes,
I keep,
please
sorry,
do.
I said I was
No,
going to
you're
ask too
just-
many questions.
You're just fine.
So hypothetically, what would happen if that building went into foreclosure? Like, what does the process look like?
If the building went into foreclosure and we reported that to OHCS, which of course we would have to do, then we would be obligated to repay $1 million of the original development grants, and we would have to dissolve our organization, sell our other properties. Honestly, I don't know. It was such a catastrophic event that we couldn't even entertain the idea of how we would respond to that.
So, formulating my question. First, I'm really sorry that you guys had to go through that, and I know it's impossible to get a blood out of a turnip, but what would happen to the property and the people who live there?
The question that you had was, what happens to the property?
Yeah, so what would happen with the property? Would OCHS take it over? Like, what happens?
That is an excellent question that I honestly don't know the answer to, and I'm sure there are experts in this room that would be able to answer that more adequately than I, but I imagine that there would be a strong risk that those residents would be no longer able to occupy that building, or at least no longer have the affordability.
Thank you.
I do have a question.
I'll let Representative Mannix go while Natasha works her way up. I think we might have a little bit more insight to the question asked previously. So Rep. Mannix, go ahead.
Well, it seems to me that we're talking about, I sometimes use naval analogies. So you have a fine ship that has sailed the ocean for years, but at some point you realize it's developing some leaks. You don't let it sink. You put money into repairing it and improving it so they can continue to carry on its mission. And I was writing down repair, renovation. What are we doing to enhance repair and renovation? And I appreciated your comment about the 11Q general obligation bonds. If we have invested in affordable housing and rental housing, why aren't we reinvesting and maintaining that housing so it is usable? And it's not really a philosophical question. I'm asking, couldn't we be doing practical stuff here to take care of this?
Yes, sir. I believe that there could be.
That's the good answer to a rhetorical question, a leading question.
Thank you. And Natasha.
Great. Yeah. So I think the situation will be variable based on the specifics of what is in the legal documents and the structure. I think in general, OHCS is invested into these projects along with another primary lender. And so Article 11Q bonds is a little bit of an exception in terms of how we've legally built those structures. And we are working on an analysis of the ability to use Article 11Q to support preservation that was included in the budget note for a bill somebody knows the name of last session. But functionally, so what that would do when the owner goes into default and foreclosure, their primary lender would initiate a foreclosure process similar, and so we would also be noticed as in part of that because we're recorded in there. And then that primary lender is in the driver's seat for just figuring out what are the next steps towards foreclosure. And so where they can find somebody to purchase it, they would probably do that. But you're then talking about, litigation, foreclosure, all of that. I believe in most cases, the lender would then, because they're in the primary driver's seat, be responsible for retaining some version of project management so that it could continue to operate unless they choose a different strategy and want to have the project, for some other motivation to have it vacated. But I think functionally they would, and there is a high likelihood that if that completes foreclosure, our affordability requirements could also be foreclosed upon, because what that lender is in that driver's seat to do is ensure that they are recouping their resources if they are able to get resources that are further down the line to repay the state resources. That would also be part of it. And I think part of what you also have in your portfolio are projects with our federal investments that were required to have loan repayment if they cease to be being affordable at that time. So I think that's where there's this additional acute impact, even if the worst case scenario, it could be then have other financial harm to the organization. And I think the thing to do is, yes, I think Representative Mannix, to your point, I think our stabilization investment strategy is to invest a little bit of resources that would help forestall and avoid that whole thing happening by reducing their debt payment. So saying you can pay this much in a loan monthly, so let's make your loan, figure out how to get your loan that size in order to have the bigger impact long term.
One final question, Madam Chair.
Yes.
So why don't we creatively look at, we have working people in a lot of these projects. They're trying to pay their rent. Why aren't we talking about something positive, talking to employers saying, can you help this person with rent? We'll give you tax, I know I'm talking about spending money, give you tax credits for you to support them in their housing because of the costs that have gone up. Better yet, we'll help you renovate this housing so it is attractive. There's a whole bunch of things it seems to me we could be doing that in a community, the employer may be very happy that Susie Q, who's been a good worker, is able to stay in that housing and the employer has provided some sort of benefit. So I keep throwing out this stuff, Madam Chair, but I think that's part of the opportunity here is to be thinking ahead. What can we do before the fire starts, not wait till the fire is started? Thank you.
Thank you, Representative Mannix. Thank you for coming up and helping
Yeah.
shed
Thank you.
that much more light on the situation and
Yeah.
options in front of us. Thank you for
Thank
the
you.
presentation, Erica.
It's dangerous when you let
We
me
are
sit.
going to move to Sarah Stevenson, who I believe is online, joining us from Innovative Housing. Sarah?
Yes, hello, good afternoon. My name is Sarah Stevenson. I'm the Executive Director of Innovative Housing, or IHI. We are a nonprofit, statewide affordable housing developer and operator, and we currently own and operate over 1,200 affordable apartments at 21 properties in Oregon. The majority of them are in the Portland metro region, including one property in Representative Ruiz's district, but we also have housing in Albany, Astoria, and Lincoln City. Nearly half of our properties are financially troubled. Thank you for this opportunity to share information about some of these challenges. I'll add a little bit of color to what you've already heard. Our downtown and centrally located properties are in worse condition than our suburban locations, but across the board, residents are struggling to pay rent, and our management companies are having a hard time filling units without reducing rents. At the same time, our properties are facing escalating operating expenses that in most cases exceed our income. The primary cost escalations are in staffing, maintenance and repairs, security, and insurance. Our property insurance costs nearly doubled in 2024, far exceeding the 3% cost increases locked into our operating budgets. This year, we're seeing general liability coverage premiums increase by 83% to over 1,000%. Because our rents are restricted and our operating budgets are locked in from the time of development for the next 15 to 20 years, cost escalations like these are unmanageable. When property expenses exceed income, several things happen. First, the property cannot afford to pay its bills, sometimes resulting in interruption of services. Second, the nonprofit developer guarantor is obligated to make operating deficit guarantee payments, basically taking on payment of the property's bills. For small nonprofits, even one or two struggling properties can pose extreme hardship. For larger nonprofits, the scale of our portfolios means that those obligations are correspondingly larger. For example, in each of fiscal year 24 and 25, IHI contributed over $1.5 million of operating support to our properties. We continue to pay the bills because the alternative is to shut down the housing. We're committed to keeping our doors open, but we only have so much money. This is not a sustainable practice, and it will inevitably come to an end. Third, even if IHI pays the bills out of our organization's reserves, our lenders require each property to collect income in excess of expenses, DCR covenants. When we cannot do this, we trigger defaults on our mortgages. IHI has 8 properties in default right now. Fourth, properties operating in the red cannot afford to pay for resident services, let alone provide operating revenue to support our organization's staff and basic infrastructure. The cumulative effect of IHI providing support to properties while also foregoing operating revenue is extreme financial duress. We cannot continue to spend millions more than we collect each year. Over the last 20 years, IHI has established well-funded reserves. This liquidity is important to lenders as well as IHI, but it has now been significantly eroded, putting IHI in a precarious financial situation and impacting our ability to borrow money. This in turn makes it increasingly difficult for us to develop new affordable housing that the legislature and the state are counting on nonprofit developers to build. So that's my dreary picture. I'm sorry it's so sad, but we have reached a crisis point and we are going to start losing housing if we don't find solutions. Thank you for your creative thinking and your partnership on this.
Thank you, Sarah. Are there any questions for Sarah? No. We appreciate you being here and shedding some light on the challenges that you're facing. I think we've definitely seen some themes coming forward in today's conversation. So at this time, we will turn it over to Peter.
Great. Thank you, Vice Chair Bree Iverson, members of the committee. My name is Peter Hanley. I'm Executive Director of CASA of Oregon, Community and Shelter Assistance Corporation. We work throughout the state, mostly in rural areas, serving the needs of farm workers and other low-income populations. I just wanted to make a correction for Rep. Mannix. He talked about only having been involved in affordable housing for a couple of years. We served 26 years ago on a farm worker housing task force that really led to some great improvements in farm worker housing. So he's not a novice, even though he sounds like he's trying to be one. So thank you for your work. So CASA for the last 20 years has been working with the state of Oregon to develop a manufactured housing preservation program. And preservation is the fourth pillar of preservation at OHCS. They recently moved the program from affordable rental housing over to home ownership, I believe recognizing that it's a home ownership program, long-term permanent affordability. And so in the earlier presentation from OHCS, I believe that is a recognition that it's now moved over to the home ownership side of things. So since 2007, you can see the numbers, 28 resident-owned communities throughout the state. Most of these homeowners, predominantly lower income. We help them purchase the park, and we stay involved throughout the term of the loan to make sure that they're able to manage the park as a resident-owned co-op. The picture on the bottom is Talent Community Cooperative. This is a fire-restored community down in Southern Oregon in the community of Talent, where 81% of the homeowners are under 60% of AMI. On this slide, we have a comparison of the first column being the total dollars invested in resident-owned communities, and you can see the cost per space there of this $81,000, a very modest investment. The state's average subsidy over the lifetime of this program has been $47,000 per space. Now, folks own the homes, so we're not doing any ongoing maintenance. Average subsidy over the last 5 years has been only $67,000. That second column is the Talent Community Cooperative cost of construction down in Southern Oregon. You can see the modest cost per space of $252,000, almost $253,000. Excuse me. That's compared to a project that we recently completed in Salem, where the per unit cost was $387,000. Now, the thing about these projects is the rent really stabilizes. As you can see across our co-ops, it's about $500,000. Rent ranges $275 to $785. Obviously, some of these parks are in areas where cost of housing is a little more affordable. Rent increases if they occur, and I put the if they occur. On average, rents are only being raised about every 4 years in these. And in a couple of the co-ops, the rents have never gone up. And I just wanted to list what's going on at one park in Bend where the rent space is $500 compared to $2,350 for a apartment. Vacancy rates are very low. As you can see, vacancy rate is about 2% when you pull the RV spaces out, which is well below the 6% vacancy rate that was in the report that was discussed earlier. Expenses are staying pretty stable. Remember, there are not expenses related to the actual units themselves because the residents own the units themselves. And so what do we need? We had asked for $25 million in the 2025 legislature. You kindly gave us $2.5 million. That will get us maybe one small park. We've got a couple parks currently in the conversion process with some bridge financing that the state has provided us with. That bridge financing needs to be converted to permanent financing, and then we can start putting that bridge financing back out on buying some new parks. We've got some major infrastructure repairs in a number of our parks around the state, and so we'd like to get those completed. And then we'd like to continue this program forward, and we're asking for about $6.4 million to do that. And with
Quick
that,
inquiry,
Sorry, go ahead.
just to understand this, and we're talking about co-op arrangements where the folks actually have an ownership interest. We're not talking about some New York investment group coming in and creating some sort of a structure. Am I following you right?
Rep. Mannix, Vice Chair Brees Iverson, that is correct.
Thank you.
The residents own the land under their homes. The co-op elects a board of directors. The co-op members themselves elect a board of directors who then run the day-to-day operations of the co-op. And no rent increases without a vote of all the residents. And that concludes my presentation. Thank you.
Excellent. We have some questions?
Yes, thank you. Quick question. On the slide with the 3 examples of per space
I
per
don't know how to
unit
go
price.
back here. Oh, there we go.
Thank you, perfect. So that 387 on the last one, can you do a breakdown of how did you get, what's that number? What's the,
So I might ask my colleague Alex to come up and help me out exactly on that number. But as I understand it, that's per unit complete construction as well as the underlying land. Is that? Yeah.
so that includes the price of the land in that 387 per unit price?
Rep. Edwards, Vice Chair Brees Iverson, yes.
Okay, thank you.
Can I do a follow-up? So hypothetically, we're saying $387,000 is affordable housing?
Rep. Levy, Brees Iverson, I could ask Oregon Housing Community Services to come up and give you some average numbers of what it costs to do the average apartment. And it's going to be, in many communities, well north of that, depending on what city they're in.
Apartment, this is not a standalone.
This is a 45-unit.
Per door cost is $387.
Correct.
That makes way more sense. Okay.
I'm sorry, did I?
No,
okay.
it's not you. It's
Okay.
our brains are getting tired. Yeah.
We were thinking the same thing, so, okay.
That's good information to get more clarity on my slide. Thank you.
Any additional follow-ups or questions? No.
Makes way more sense.
Any on this side? No? All right.
Great, thank you.
Thank you very much. All right, at this point, we will invite Bill Van Vliet, and I believe you are, yes, online, so the floor is yours.
I am. Thank you very much. Vice Chair Brees Iverson and members of the committee, my name is Bill Van Vliet, and I'm the Executive Director of NOAA, the Network for Oregon Affordable Housing. NOAA is a statewide nonprofit that provides financing for multifamily affordable housing projects and manufactured home parks throughout the state of Oregon, many of which are the co-ops Peter was just talking about. NOAA offers a wide range of financing programs. We have over $420 million of capital available to lend in our work, and that capital comes primarily from 25 Oregon banks, but also from some foundations and other public sources. We currently have approximately 130 permanent loans for affordable housing projects. And over the last 3 years, like Oregon Housing and Community Services has noted, we've observed some significant declines and degradation in the operating performance of those properties. A year ago, we completed a 5-year operating analysis in our portfolio, and we're able to show a dramatic change in the operating environment. And the results were confirmed by what Oregon Housing and the Portland Housing Bureau have both concluded with their own studies. We convened a group of stakeholders collectively in early 2025 to identify the scale of the problem and to make recommendations for solutions, several of which were passed by the legislature during the 2025 session. Project owners also identified 36 projects that they felt were on the brink of foreclosure, and another 112 that were losing money each year. And I think those numbers bear out what Natasha found, and you heard from other developers who testified today. Unfortunately, the $50 million of lottery bonds that were allocated for all of preservation needs is inadequate. The Housing Alliance had identified a need of $285 million to preserve projects with expiring affordability, including manufactured home parks, and help stabilize existing portfolios to prevent foreclosures. Industry and lender fears from last winter are beginning to materialize. We're moving past technical defaults into true payment defaults. In NOAA's 37 years, we've never experienced a foreclosure, and we've had one late payment. Right now, we have one loan that's gone 5 months without payment, and we have others that are determining their ability to pay month to month. My banking colleagues also report payment defaults. Some lenders are working on forbearance agreements, but those are temporary fixes, and without permanent solutions, those loans will migrate to foreclosures. One large owner has recently placed their entire portfolio up for sale, and many others are selling specific projects. The risks from underinvesting in preservation are clear. Projects are beginning to fail and may be lost to foreclosure. Inflation-driven operating costs are unsustainable and are dragging down owners, stripping them of liquidity and placing entire organizations at risk. This places their portfolios at risk. And developers with challenging portfolios and diminished liquidity will not be able to attract private capital for new developments. That will harm housing production goals. Each of these outcomes places vulnerable low-income Oregonians at risk of losing their affordable homes. Each of these outcomes is occurring today. We need additional investment in preservation. If it's possible, the Housing Alliance will seek an opportunity during the 2026 session to increase the overall allocation of Article 11Q bonds to provide funds for this purpose. These bonds have historically only been used for new housing production under the LIFT program, but with the dire need for preservation funding and no alternatives, we believe it's time to tap this resource. To eliminate concerns about eligible uses, Senator Pham sought a legal opinion from Legislative Counsel who confirmed that Article 11Q bonds could be used for many types of preservation applications, including manufactured home parks. The opinion has been provided to you today for your reference. An allocation of Article 11Q bonds will help Oregon Housing and Community Services and industry partners preserve affordable homes at risk of being lost. Funding new production and preservation is not an either-or decision. Both are essential for improving housing supply and affordability, and we cannot wait for 2027. Thank you for the opportunity to speak today about the importance of housing preservation and stabilization.
Thank you. And I will just note for the record that that opinion is it has been uploaded in OLA, so you guys can find that legal opinion from